Hi all, my name's Bowen Hosking, Equity Analyst for Enhanced Asset Management. I'm joined today with Russell Muldoon, our Portfolio Manager. How are you, Russell?
Good, mate. How are you?
Yeah, very well, thank you. So we're just here to just have a quick chat about just current market conditions and some key factors that are impacting our portfolios at the moment. And I'm sure us as investors, we're all experiencing a fair bit of volatility at the moment. So we just thought we'd sit down with you guys and have a chat and talk you through what we're seeing as well. So I guess straight into it, we'll just go straight into the hot topic, inflation. Everyone's talking about it. Can you give us an idea of what's going on at the moment and how it's affecting portfolios?
It's obviously having a huge impact on markets, both equity and bond markets, and obviously because of that, it's having a huge impact on portfolios. So back in February, we sort of discussed the fact that the current consensus view around the time was inflation was going to be a transitionary phenomenon. That was the widely held consensus view, and that would have likely had come to pass had the status quo remained the same. But obviously the big thing that's changed between our previous update and this update has been the invasion of Russia into Ukraine. Obviously, Russia is a huge powerhouse in terms of commodity production, particularly in petrochemicals. Ukraine is big on soft commodities, grains, such and so forth. Both of them together have sent commodity markets into, it's been one of the biggest commodity booms I've ever seen. Yeah. And particularly in terms of portfolio positioning by a lot of fund managers, it's off the charts it's never been higher in terms of commodity exposure. Typically when a war breaks out, what we get is a scenario where markets fall and the bonds act as a bit of a balance, a bit of a stabilizer for the portfolio. But in this case, everything has literally fallen. And the reason for that is because we've had these commodity spikes in virtually everything across the board. The inflation, which we thought was transitionary, suddenly just got built and built and built and built. And all the pressures coming through from cost push. So when it costs more for petrochemicals, energy, costs more for grains, it costs more for absolutely everything. Obviously, that leads to more inflation. Yeah, of course. So it's been we've since we started these portfolios, we've been through two periods where we've had bear markets, we've had the COVID crisis, and now we've got a war which is doing the exact opposite to normal wars and what the impact that has on a portfolio. So it's been a pretty crazy time for investment markets.
It certainly has. And I guess another key issue that goes sort of hand in hand with inflation is interest rates. And I mean, we sat down here 3 months ago and we were speaking about, the crazy market at the moment. We've got bond yields up at 200 basis points, 2%. And we thought, well, can it go higher? They're currently sitting at about 3.35% at the moment. So can you talk us through that and what's going on there and how that's kind of affecting equity valuations as well?
Yeah, sure, Colin. So that was my comment before. Bonds in a war type environment, there's usually a flight to safety. So people pull out of riskier assets and they go into safer assets. So government bonds being one of those safer assets. But the inverse has happened this time. As the inflation's gone up, inflation is the worst thing for bonds, effectively, because it erodes, because they're largely fixed income securities. Inflation erodes their purchasing power over time, so people demand more of a yield to compensate for that inflation. Inflation 8.3 in the States this week. Crazy. Phenomenal, absolutely phenomenal. We're seeing companies having to pass on 10% cost inflation over a 12-month period. Speaking to a couple of local companies in Adelaide, Hakes Chocolates, for example, they're talking about 6 and 9% price increases going forward. So that's 15% over a period of 18, 24 months. So it's everywhere. And the impact that is obviously happening is if bonds are 3-4%, equities naturally have to fall. You're getting quite a high yield over here. Equities no longer look as attractive. So the yield on those, the share prices are compensating for that by falling. Yeah, of course. And that's what we're seeing at the moment. We're not seeing an issue with corporate earnings at this point. No. But we are seeing the compression in forward multiples, or the compression or the lower valuations that people are willing to pay for shares coming to the fore. So until we get a bit of a reprieve in either inflation, 12 months from now we'll be cycling pretty high numbers. So the inflation numbers are going to start to look better. So we think bond markets have probably peaked out here. that's positive going forward. And if we get a resolution, obviously, to the conflict,
the war,
they're the two big drivers. But and on top of that, you've obviously got China at the moment with their really oppressive lockdown measures going for COVID zero, and all the issues that's creating with the supply chains. There's a lot of
moving
really
parts,
large macro things that are flowing through the markets at the moment and creating quite a challenging investment environment across not just one asset class, but pretty much all of them. So, it hasn't been a very fun time, but, in terms of client portfolios, if we just think, if you're going to set yourself up for a 5 to 10 year journey, there's been 15 to 20 bear markets since the 1950s. We've unfortunately had 2 in the last 2 years. They'll come, they'll go. We just got to stick to our strategy and see it through.
Yep, that's right. So you've talked about this the effects it's having on every asset class. Let's dial in on the asset class we love talking about, our Australian equities, our direct shares. So we've held 3 different stocks over the past quarter. We've held obviously Elders, EML Payments, and Unity Group. We now only hold 2.
We do.
So talk us through that. We've just sold Unity.
Well, I think Unity is obviously under a takeover offer at the moment from a consortium, and a well-funded consortium. But it's not an unconditional bid. So we bought Unity when it corrected quite severely, and within a fortnight it was underbid, and we've done pretty well. I think we've exited with a 50% gain. We were going to hold, or we were holding on to it, fearing it's such a high quality asset that another bid might eventuate and we might get a little bit more of a return. But given what's happening in equity markets, there is a material out clause. There are a couple of material out clauses in the Unity bid, so it's not an unconditional bid from the consortium. Therefore, the downside risk, if you look at something like a Link, where Link is fallen by 20%, the funder may not, or the bidder might not be able to get the funding. That's a separate issue to Unity, obviously. But it just goes to show that the upside is now probably less than downside risk for Unity, for example, if one of those material clauses did come to fruition. So we decided to exit that just this week.
And fantastic result, 50% gain for our clients. We're all very happy. So other ones we still hold EML and Elders at the moment. So Elders has, we talked about the commodity prices and the boom. Elders has been a bit of a beneficiary of that. We've seen, some good grain results, and cropping conditions over the next 12 months, 18 months look really positive. And, it's been a very good stock to hold at the moment. It's done about 16% over the past 6 months compared to the market that's done -5, -6. So we're seeing some good returns there. Pretty confident holding that one moving forward?
It is a cyclical business, and we have to be aware that we are going through some very volatile cycles at the moment. And particularly interest rates. So, if you understand their business, it's a large part of their business is retail. So selling agricultural products to farmers, fertilizers, for example. They do have a property division, which is, it's gone through an absolute boom in terms of farm property prices.
Valuations
But what we're seeing is something like a Vanguard Australian Property Trust, for example, which is listed on the market, VAP, that's fallen 12.5% month to date. So that's in direct response to interest rates now going up. So as interest rates go up, obviously property prices, like equity prices, like bond prices, are going to fall. So that's a bit of an issue for potential sales of farms going forward. And that vendors' expectations might still be too high, and therefore those properties might not move on so quickly. So there's a bit of an earnings headwind there. So I can start to see a few cracks in the Elder story starting to develop. But in terms of the bigger earners, the retail division, very, very strong. Land prices are still very strong. Animal prices are still very strong. So I don't see a lot of risk there for the moment, but it's one we're watching.
That's good. And then obviously EML, kind of leave the best till last, I guess. It's been a wild ride, and unfortunately it hasn't quite gone our way. Revenue growth has been fantastic for the business, but just cost control over the past 6-12 months has been really disappointing, and especially when you're getting communications from management saying things are going really well, we expect, not too much cost growth, things are looking really strong for us, and then you see a big downgrade like they got 2 weeks ago now, really worried us a little bit. And what's our thoughts there? Where are we positioning ourselves on that one? Do we see a big recovery coming?
Yeah, I guess that this kind of plays into the inflation theme a little bit. They've had a little bit of issues with part of their banking in Ireland, which they said they were through. But labour costs in Europe are just going through the roof. Yeah. So they've been hit somewhat there. We think it's been oversold basically.
Oh, for sure.
And it's been caught up in not only a bit of a downgrade, but it's been caught up in the tech sector sell-off as well. But for example, at the moment we have EBITDA about $79-80 million.
Yep.
And if we apply a very conservative 10 times forward multiple on that 24 number, which we think is very achievable, it equates to about $2.20 a share. That's a very conservative valuation. So it's about 50% upside from where it is today, just to give you an example of how oversold potentially, if everything comes to fruition like we expect it to. A slightly more optimistic case with 12 times forward, and we get a valuation that's almost 100% from where it is today. Yeah. So yes, it's been a bit of a frustrating holding. It'd be nice to have all three, individual shareholdings work. Doesn't always work out like that. So 2 out of 3 isn't bad. Just that EML's fallen so far, but it's certainly in our view oversold at the moment.
Yeah. Of course. So I think we'll wrap it up there, Russell. There's some good insights there. Hope everyone is surviving the volatility at the moment, and our portfolios are continuing to perform really well. So
we're happy. It's just in these environments which we have been through before, it's important that with your advisor that you've got your plan from day one. We've got a 5 to 10 year view on our portfolios. We try not to turn them over too much because of the costs, transaction costs, taxation costs. So we're just going to ride out these periods, and we're optimists by nature. So Absolutely. We're optimistic that the future will look a lot better than the recent past.
Thanks.
Thanks, Mark. Thank you.